Hello, my name is Kyle McLean, and I'm a partner and senior wealth manager here at Raymond Gorell Wealth Management. Today, we're going to discuss a powerful tax strategy that applies to restricted stock, the 83B election. We'll also answer questions involving what the 83B election entails, the difference between restricted stock awards and restricted stock units, how the 83B election works, as well as the risks involved, and much more. If you receive restricted stock compensation, understanding this strategy has the potential to significantly reduce your tax burden when managing grants from your company. Before we start, if you or someone you know could benefit from this strategy or the other services our firm offers, feel free to contact our team for a complimentary consultation where we will review your financial situation to identify opportunities for optimization in areas like tax planning, investments, estate planning, and employer benefits. So, what is the 83B election? The 83B election is a tax provision that allows employees receiving restricted stock awards, or RSAs, to prepay taxes on the fair market value of the stock when it is granted, rather than when it vests. Normally, RSAs are taxed at the vesting date, and the taxable amount is based on the fair market value of the shares at that time. This can result in a higher tax bill, particularly if the stock's value increases substantially during the restricted period. By making the 83B election, one can lock in the current fair market value at the grant date, potentially lowering your tax burden in the long run. It is important to note that the 83B election applies specifically to restricted stock awards, or RSAs. The 83B election is not available for restricted stock units, or RSUs. This is an important distinction, as many companies issue RSUs instead of RSAs. So how does it work? The 83B election applies when you receive RSAs. You must decide whether to make the 83B election within 30 days of the original grant date of the stock. By making this election, you will pay ordinary income taxes on the fair market value of the stock at the time of grant, even though the shares have not yet vested. This may seem like a risky move, but if you believe the stock will increase in value over time, the 83B election can be highly beneficial. Once the shares eventually vest, you will not owe any further ordinary income taxes. Instead, the increase in price over the value at the time that you made the 83B election will be taxed at capital gains rates at the time of sale. These capital gains rates are generally much lower than ordinary income tax rates. The 83B election also causes your ownership period for tax purposes to begin at the time you make the 83B election, instead of at the time of vesting. This is important when determining long-term versus short-term capital gains rates. Let's look at an example to illustrate how the 83B election can work. Imagine Pat, who has been working for a company for 5 years. Pat is granted 5,000 shares of restricted stock that will vest over a 5-year period. On the grant date, the stock is valued at $20 per share, but Pat believes this stock will grow in value over the years. If Pat makes the 83B election, he will pay income taxes on the initial $100,000 value of the shares, 5,000 shares at $20. Over the next 5 years, as the shares vest, Pat won't owe any further income tax on the stock at vesting. If Pat sells the stock after it vests and the value has grown to $40 a share, the additional gain will be taxed at the long-term capital gains rate, which is generally much lower than the ordinary income tax rate. In this scenario, Pat could potentially save thousands of dollars in taxes by making the 83B election up front. However, it's important to note that the 83B election comes with certain risks. If you leave the company before the shares vest, you still have to pay the taxes on the grant date value, and those taxes are non-refundable. Additionally, if the stock price declines, you may end up having paid more taxes than you would have had you waited to the original vesting date. This is why it's crucial to carefully evaluate your situation and the likelihood that you'll meet your vesting milestones. Working with a financial professional to walk through the potential scenarios can help you determine if the 83B election is the right choice for you. In conclusion, the 83B election offers a unique opportunity to save on taxes for those who receive restricted stock awards. However, the decision to make this election should be made carefully, considering both the potential rewards as well as the risks involved. Our team at Raymond Gorell Wealth Management specializes in helping clients navigate the complexities of employer stock compensation and advanced tax strategies like the 83B election. If you'd like to learn more about how we can help you optimize your financial situation, we invite you to schedule a complimentary consultation with our team. Thank you for joining us today to learn about the 83B election. We look forward to helping you make the most of your employer benefits and plan for a successful financial future.